Published 0811 EDT, the 22nd of September 2017. Updated 1108 EDT, the 22nd of September 2017. How would you feel if every scrap of your personal financial data was openly available for any retail finance business in the UK to access? You should start thinking about it, because this is exactly what is about to happen in the UK. From the 13th of January 2018, all retail financial institutions, banks and building societies in the UK and in Europe will legally have to provide open access to all their customer data to any regulated third party that asks for it. Open banking should make it far easier for us to manage our money quickly and easily. There are two reasons for this open banking: a set of rules from the UK Competition and Markets Authority and the European Payment Services Directive 2 PSD2, another set coming out of Brussels. The pros: both are designed to force banks, building societies, insurance companies and investment houses to provide better service by forcing them to open up their proprietary data and put it back in the hands of their customers. In theory, the rules should mean that over time we are able to open one app on our phones or log into one platform online and see every financial account we have in one place. More than this, if you can see you're paying 20% interest on your MBNA credit card balance and earning 1.2% interest on your savings with NatWest, for example, this app should theoretically alert you and prompt you to switch to better rates or pay off the debt using the savings. Similarly, if you've slipped off a mortgage deal onto your lender's hefty standard variable rate and could save by remortgaging, the system ought to be able to search all your available options from all providers, allow cross-checking with your income and expenses by using your current account data, and then provide you with the option to sign up to a new mortgage deal you're already approved for. Goodbye bank branch appointments, paper bank statements, and payslips, and having to post your passport to prove you're EU. It would eliminate the need to search manually for cheaper energy deals, credit cards, savings accounts or loans. All of this information would be in the app automatically, and unlike when you search a price comparison website, it would be personal to you. In a perfect version, if you have a money left over each month from your salary, the app could work out what to do with it, be that putting it into your ISA, pension or other investment. All of this in a single app that manages it for you. All you need to do is click yes or no when prompted. The potential cons: in theory, it's the biggest game changer for the way we manage our money since banks were regulated. In practice, there is a whole host of potential pitfalls, problems and dangers that need to be considered. To help you get a grip on these, we've pulled together the questions and answers we think you need to know about right now. If you have any more, email sarah.davidson@thisismoney.co.uk and we'll add your questions to the list. What is open banking? Uber has changed the taxi market completely. Open banking is the name for the regulation designed by the Competition and Markets Authority. This is one of the government-backed watchdogs in the UK, and its remit is to make sure competition between companies works properly. They looked at retail financial services and decided that WASNT, compared to the way Uber has disrupted the stranglehold black cabs had on the taxi market, the way Airbnb has turned travel accommodation upside down, and the way Amazon has transformed the way we shop, banking remains utterly behind the times. One reason is that banks don't like sharing your data. They like to think of you as their customer rather than you as your own person choosing to use services from a variety of providers. Regulation and compliance has also been a barrier to sharing data. Open banking aims to turn this view around, putting you back in charge of your money by helping you see everything in one place and enabling you to act to change anything you want. How does open banking work? Open banking will force banks and other providers to make a standard set of APIs available to regulated third parties. API stands for Application Programming Interface. This is basically a set of codes that allow different and separate technology platforms to talk to each other. This means that, for example, American Express could talk to Santander, meaning they'll be able to see whether you qualify for an Amex card based on your income and outgoings in your Santander current account. In order to have access to these APIs, companies must be regulated by the Financial Conduct Authority, so your data isn't available to just anyone. Data will also be encrypted and protected. And, you'll have to give your permission to share it. If you opt out of allowing your provider to share your data with third parties, it will remain locked away, but you won't be able to access it in one place in the way those who do choose to allow it to be shared will. Open banking should put customers back in control just by unlocking their mobile. Doesn't this already exist? No. There are a few apps that look like they do this already. Money Dashboard is the obvious one. These apps tend to scrape your data from other providers and can display all your accounts in one place. To do this though, you have to provide them with your password and log into connected accounts, which voids many banks' terms and conditions, and were your account to be hacked and money go missing, your bank might not cover you. You also can't act on any of the data displayed. You might be able to see that you're paying high interest on one credit card and earning no interest on some savings, but to switch accounts, you'd have to go directly to the provider of that account. There are some platforms that already have the ability to scale up when the new rules come in though. Starling Bank, for example, calls itself a bank, but it's not in the traditional sense. It doesn't hold your money for you or make loans. Instead, it acts like a marketplace, plugging other providers into it to allow users access to a range of products through its app. How safe is my data? Being a regulated business doesn't mean that these firms are immune to cyber attacks that breach your data security. This is the big unknown. The regulation means that while institutions can share your data, those they share it with must be regulated by the Financial Conduct Authority. This should provide a layer of security that makes any money you might lose eligible for compensation through the Financial Services Compensation Scheme under existing rules. But being a regulated business doesn't mean that these firms are immune to cyber attacks that breach your data security. Consider the latest in a long run of crippling cyber attacks. The Equifax data breach exposed 143 million Americans' highly personal information, while up to 400,000 British victims were also affected. Money sitting in your savings or investment account is valuable, but increasingly, your personal data is more valuable. If fraudsters get hold of enough of it, they can use your identity to commit crimes and make billions off the back of them. Who's responsible if my data is stolen? The regulators, providers and government are still pretty unclear on this point. According to those in the know, there are ongoing discussions between them and insurers to work out where the buck stops in the event of a cyber attack. When they figure it out, we'll let you know. Do I have to allow them to share my data? To complicate matters, there is more regulation coming. In May 2018, General Data Protection Regulation (GDPR) arrives from Europe and will force all companies, whether in financial services or not, to get your consent to share your data. If you choose not to share, this doesn't necessarily keep your data safer, but it could potentially stop you from benefiting from open banking. No, it's your data and you have the right to do what you want with it. However, you may find that you've already given consent through signing up to the terms and conditions when you opened your current account, savings account, credit card, SIP or any other financial product. It's likely that financial providers won't just open up your data in January without telling you, though. It's probable that the government will do a big advertising campaign to raise awareness of the changes, and that providers will write to you where you hold an account that's affected. Then you can choose what to do. Who will provide this app where I can see all my accounts? This is still very unclear. The government could decide it wants to back a provider. Banks themselves could develop an app that pulls data from other banks, allowing you to see your Barclays account in your HSBC online banking app. For example, fintechs and new software companies might decide to launch a new platform that acts as a sort of dashboard. Our money is on price comparison websites developing their existing technology platforms to link into provider APIs so that when you log in, you can view all your data through them, and when you search for better deals, they've already got access. The other possibility is that an entirely new sort of company emerges that chooses to focus on providing really secure and protected data using something like blockchain so that users have more peace of mind that they're safe. When will I get access? Providers have to make their APIs available on the 13th of January next year, so thereafter, don't expect technology to pop up overnight though. The development of new apps, security protocols and platforms that support customers accessing their money in this way is likely to take years. Come 2023 though, it should be a reality. Davidson. It's not the end of the banks. Open banking is being heralded by some as a revolution. But don't be confused into thinking that it's the same as AI or online robo-advice. Open banking isn't the technology, it's the rule that tells financial services companies to share their data in a way that's protected. The aim is to force banks to offer their customers a better deal, because customers will be able to see much more easily where they're being ripped off. Instead of putting the onus on you to shop around when you get to the end of introductory offers, technology should do the job for you. Ultimately, it's about making the whole customer experience quicker, easier and better. It's not the end of the banks, rather than destroying the banks by replacing them with whizzy tech. These rules are far more likely to change the way they distribute their services to you. Banks will still provide current accounts, savings accounts, credit cards, loans and mortgages. Insurers will still provide cover. Pension providers will still provide pensions and annuities. Asset managers will still manage your investments if you want them to. But how you see, choose and access all of these services could change dramatically. Instead of having 15 account numbers, logins and passwords for each individual product and provider, open banking makes it technically possible for you to have one, with all the others sitting behind it. This puts customers in control. And, for me, it raises the question of what the future holds for those firms that currently serve this function in managing money. At the moment, mortgage brokers, insurance brokers and independent financial advisors have something of a monopoly on being able to take your full financial circumstances into account and then search all products available from all providers and finally recommend the best one for you. Open banking in theory makes it possible for technology to do this in real time. While it won't give you advice and answer your questions, yet, it's possible that the role of traditional intermediaries in the form of brokers could be gradually replaced by the role of technology platforms as intermediaries instead.